Hi, everybody. Darwin here. Today, I'm going to take you behind the scenes and show you what I do with investors when we're trying to do an analysis on properties, trying to decide which one to go with, which one is better. And so this is how I guide investors through making that decision. So today is May 20th. I've just gone on the MLS. I've chosen three properties to do a quick analysis on. One in Kitchener, that's a condo apartment. One in Hamilton, that's a townhome, and one in Brampton, that's an apartment. So no particular reason that I chose those three other than they are roughly in the same general price range, and it tends to be a more attractive price range, especially for investors. You want to try to get in at a low entry point. So we've got as high as 449 for the apartment and as low as 449 for the townhome in Hamilton, 490 for the condo in Brampton. We got the 20% down payment, so that's what we see here. And that's what's required whenever we're purchasing an investment. Looking at the closing costs, which is going to be the other amount of money that we're going to require. So we've got the land transfer tax here. We've got the lawyer's fees with the title insurance. So that's what we see here. We've got the home inspection and the appraisal amount. Now, these may or may not be done, or the lender may not require them. So we may not actually have this expense, but we're going to put them on there as part of our potential expense that we may need at closing. So when we add up those two figures, the closing expenses plus the required down payment, that's what we see here. So the amount of money that we need in our pocket to purchase these properties is expressed right there. Next, we'll look at the mortgages. So these are 5-year term mortgages. I've used 30 years as the amortization, and I've used a rate of 1.99. You can probably get a rate lower than that if you're going with a variable, or you can get a rate that's higher than that if you're going with a fixed rate. Okay, so I've gone with the kind of split the difference. I've gone with 199 for the purpose of this example, but this is very, very realistic. Let's look at the actual properties themselves. This is the Kitchener property. It's an apartment, 2-bedroom, 2-washroom, 2 parking. The condo townhome in Hamilton got 4 bedrooms, 2 washrooms, 2 parking spots. And then the Brampton condo apartments got 2 bedrooms, 1 washroom, 1 parking spot. These figures we already looked at. The one that is an addition here is the down payment, the principal down payment. Okay, this is how much we're going to, over the 5-year term, this is how much is paid down in the principal, and then that becomes a part of your equity, and so a part of your return on your investment. Renovations, there's nothing here. I've not seen the properties, but based on the pictures off the MLS, they look like they're in pretty good shape. None of them look like they're in disrepair. And so I don't want to be just making up renovation numbers. But if we were actually doing an analysis on a property that we're interested in, we certainly likely would have seen the property, and we have a better sense of what this number is. The appreciation down here. So this is the purchase price on this first line. Then we look at, we can kind of choose any rate of return that we want to use, but we're going to use 3%, which is below the actual average that's been occurring. So I always like to under promise and over deliver. And so that's what we've got here. So for both the apartments, I've used 3%. For the townhome, I've used 4%, just for the simple reason that the townhome is got, typically they're going to have lower condo fees. They're larger in square footage. They've got a backyard. They come with, many of them come with a garage as well. All of these features make them more desirable for larger families. And therefore they tend to be there's a little bit more aggressiveness in pursuing these. So that's why I've put an extra percentage here, 4% rate of return on this one versus the other two. Does not mean that these may not do better than that. But like I said, we're just going to go with very conservative figures. So that's what the appreciation calculation would be there. Next, let's look at the income and the expenses. So I've looked at the areas. I know what the rents are for these types of units. Kitchener, we've got 1775. Hamilton, 2000. There's actually a tenant in there right now paying that. And then 1900 for the Brampton one. I actually know that it's even higher than that. We rented out for a client just over a month ago, and they got higher than that at that same building. So we know that that's certainly a very conservative number. When we're looking at the expenses, so taking off the MLS, we've got the annual property taxes, as high as 3,000, as low as 1,800, expressed on a monthly basis. That's what we get. Then the home insurance, once again, depends on the amount of coverage that you get, but $30 monthly for your own personal coverage of insurance on the property is, I think $30 is very, very much in line with that. Repair, you always should have some form of budget. 600 for the year on these properties, I think, is realistic. Express monthly, that's $50. Advertising costs, in the event that you've got some tenant decides to move out, you'll have a vacant period there. You have to advertise for a new tenant. 240 for the year, or is $20 per month. And so this number is usually between $20 to $30. I've put $20. The condo fees for the month, okay, taken off of the MLS. This Brampton was the only one that's actually got all inclusive. There are no other fees of any sort on top of the 548 for the Brampton apartment. As a matter of fact, this one also has basic cable. These do have separate utility bills. And so typically this might be zero. The tenant's going to pay for everything, all the utilities. So this would not be on there. The reason I've left them on there is because the one utility that the owner cannot remove their name from is the water bill. Okay, that's a municipal utility. So your name stays on it. You can certainly add the tenant's name onto it. Sometimes the landlord continues to pay that bill themselves. So anyways, you decide how that works, but that's the reason I've left that on there. The management company, there's none in this case. And then the monthly mortgage, which we've already calculated. So the total expenses on each property we have here. So once we subtract that from the income that we're getting, this is the cash flow for each of the properties here. The negative cash flow, 533 for the Kitchener one. So simply means that with the rent I'm getting and with the expenses on it, I don't have that rent is not enough to cover all the expenses. So every month I'm going to have to put in an additional $533 out of my own pocket to cover those additional expenses. The other option would be to increase the rent, but it might be harder to get a tenant willing to pay a much, much higher rent. So anyways, so that's how we get at that. Positive cash flow for the Hamilton property. Now, negative cash flow does not necessarily mean a negative return. And so we're going to look at that over here when we look at our section here on the return on investment. So when we're calculating the return on the investment, we're looking at the cash flow. So it's negative in two cases, positive in one. We look at the renovations. There were none in this case. So usually renovations create what's is also termed as a forced appreciation. We are forcibly increasing the value of the property with renovations and upgrades we would be doing. That was not the case here. The appreciation, which we looked at there, and then the pay down. So the mortgage pay down right here, pay down on the principal. And so when we add up all of these figures, this is what we get. Because these two had negative cash flow, that's why they are a lower dollar figure versus the Hamilton, which had a positive cash flow. It's a higher figure. Okay, expressed as a percentage, we see that 90% return over 5 years, 149% over 5 years, 100% over 5. Like, these are phenomenal returns, really good. Expressed per year, 18%, almost 30%, 20%. Any of these investments, I'd be happy to have any of these. This is a fantastic return on my money. If I invested 108, making 20%, I'm happy. If I invest 106, making 20%, I'm happy. If I invest $97,000 and I'm getting, 30% of my money every year, I'd be really happy. So, just on a surface look at this, very generally looking at this, certainly this one jumps out. I'd likely choose that. If I decide to sell my home, this is the dollar figure that we'd have minus commissions and lawyers' fees, and then I'd have the figure what I've got left in my pocket. So there you have it. This is just a quick overview of what I do with investors when we do an analysis and helping them to make the best decision possible. Thank you so much for joining me, and when you're ready, give me a call.